Hey everyone, we got a great video for everyone here today. I'm going to be going over my entire $217,000 Wealthsimple dividend stock portfolio. Going to be going through it one position at a time, talking about why I own each of these stocks in my portfolio, what my hypothesis is about these stocks, and what role it plays for me in my stock portfolio here. If you like this kind of content, be sure to give me a big thumbs up. I haven't done a video like this in a couple months, and we've had a ton more subscribers join the channel, so thought I would do a updated one, especially since I've been adding and subtracting a couple different positions in this account, so it would still be somewhat new for everyone. So I'm just going to jump into this video here. In my Canadian portfolio here, I have $133,000 total. It's been rocky over the last 3 months or so. I'm down just about $1,000. It was down $3,000 or $4,000 at one point, but in the last month or so, it's repeated or rebounded rather a bit here, up about $700. If I go to my portfolio overall, you can see the Canadian side hasn't done tremendously well in the last almost 3 years now. We're just up 3%. So there's been a lot of volatility. When I started investing, some stocks were super high and they have gone down with interest rates going down or going up rather. So I have that as a bit of a headwind, but overall not too bad, not catastrophic or anything, just not great returns on the Canadian side. On the US side here, I've done a lot better. I'm up 14% all time, up 20% just in the last year alone. So we'll get through what stocks primarily drove those gains. Starting on the Canadian side, the first stock that I own in my Wealthsimple portfolio is Allied Properties. Now, I've talked about Allied Properties a couple times, but Allied Properties is an office REIT. They primarily operate in major cities in Canada, so think like Toronto, Montreal, Vancouver. I'm sure they have some presence in some cities like Waterloo and stuff like that are tech hubs. And they primarily rent their space out to technology and science type tenants in terms of the office space. So they try to really rent their space out to industries that are growing rather than maybe looking for quicker places to cut money. So overall, this company has not been performing well, with overall, office valuations declining, vacancy rates going up with people working from home during COVID and whatnot. So they've had a huge hit to their shares, about 50% over the last 5 years. Their net asset value is still over $50 though on this company. So if all their real estate was to hit the open market at what people justified are fair prices for the real estate, they do accounting on a quarterly basis on that and get everything appraised, the stock would be worth $50 a share. There's just lots of concern that they may not be able to refinance their loans as easily because banks may not want loans like this on their balance sheet. And does that cause a credit crunch and everything else that may go on with that? Do vacancy rates continue to go down? There's lots of pessimism in this stock right now. They're expected to do $2.20 of funds from operations, so trading at under 10 times current year funds from operation, which is a really attractive valuation, at least you're getting for the risk that this company has. Overall, I'm down about 25% on this one, and I'm getting about an 8.5% dividend yield at these rates, which is really awesome. They've actually increased their dividend each year of the last 10 years, I think. So by getting a starting yield of 8.5%, it's really just hoping that things stabilize in the market for office real estate. They're able to refinance their loans when they become due. They can get good rent increases on their existing office tenants and whatnot. And it's not like they're operating in these like ghost towns. They're operating in downtown Toronto on some of the most prestigious streets in the country. So I feel like they'll figure it out. Maybe they don't get all the way back up to $50, but even if they get to $30, I'm getting 50% upside in addition to getting an 8.5% dividend yield to wait. So I do like the risk reward on that one. It is one of my more risky stocks that I do own. Going next into A&W Royalty Income Fund. So A&W Revenue Royalty Income Fund gets a top line revenue share or royalty on every dollar that's spent at A&W restaurants in Canada. You can see here they haven't done too well year to date as well, down about 4%, but this one pays a dividend close to 6%, and it's a monthly paying dividend as well. This one also has increased their dividend 2 or 3% every single year in recent memory, with exception of the pandemic. But I'm pretty sure they're at all-time high in terms of their distribution. So you're getting nice increase as these companies, increase prices and get more same-store sales growth, more population growth over time that are buying from fast food restaurants. And one of the reasons I've mentioned this before, I really like A&W, is because one, they're pretty inflation proof in the sense that even as rents go up, even as cost of labor goes up, cost of goods goes up, the only thing that matters for this company and for this stock is top line revenue. So as these restaurant chains have to increase top line prices in order to build in margin to pay for all of those inflationary drivers, it's actually also giving you a raise, assuming the volume and the amount of product they're moving remains flat. So it's a bit inflation proof in that sense. The second thing is a company like this, I feel, is somewhat recession proof. As the economy goes down, or if the economy goes down, lots of people who are doing sit down restaurants, whether it's places like a steakhouse or a burger place that people are going down and sitting down in the pub, maybe they just go and grab a bite to eat at A&W. It's a lot cheaper. You don't have to tip. You don't have to be forced or feel like you have to buy a drink for $10 with your meal. So it's definitely a more attractive value proposition, just financially in times that are a bit tougher as well. So I like the defensive nature. I like the valuation, getting a 6% starting yield on it. And I have a pretty big position in my account on A&W Royalty. Third stock I have here, Bank of Nova Scotia. So Scotiabank here. I'll kind of just zip through some of these. Scotiabank, I've talked about banks a lot on my channel. Really like the value of the Canadian banks. Currently yielding a 6.3%. I think the forward price to earnings on Scotiabank is about $7.20 of EPS. So trading at about 9 times current price. With the history that these banks have over the last 10, 20, 50 years, increasing their dividend most years, getting it at a starting yield of over 6% seems like a great deal. They obviously have some exposure in Latin America that the market doesn't really love, but I'm hoping that that does stabilize over time, and I think it will, and it gives me a bit more diversification geographically into that region of the world that I otherwise wouldn't have. So I don't hate having it, even though it hasn't really been a huge value driver of the stock. And yeah, I just think Canadian banks, I have another one that I'll talk about in a bit, but Canadian banks at 8, 9, 10 times earnings are decent valuations in this market, and I'll take it and take the 6% starting yield on these names. Okay, going into my next stock here. It is Canadian Apartment Properties, or also known as CAPREIT. They are the largest residential apartment owner publicly traded in Canada. You see here, they've actually held up not bad over the last year, up about 11%. They're trading at about 20 times funds from operations. So Allied was trading at 9 times funds from operations. Canadian Apartment Properties, which is a lot of a safer play. It's like Canada has a shortage of apartments, so their occupancy rate's always very high. Is trading at a much higher amount of almost double the valuation of the earnings you're getting from this one. So that just goes to show it really does invest, like where you invest in real estate in terms of how it's being valued. And we'll kind of contrast that versus some of the other REITs that I own as well. Going into the yield here, yielding just under 3% on this company here. I love just owning this one. I think long term they'll continue to do well. They have a lot of pricing power. They can increase prices every year on lots of their properties. They continue to make strategic acquisitions, buying back shares when it makes sense, and they continue to pay and grow that dividend of theirs, even though it's not as big as some of the other ones we have in this account. Next stock here is actually kind of like my savings account, but I have about $17,500 in cash ETF. So this is a high interest savings ETF that pays me a monthly dividend of just high interest. So I get about a 5%, 5.5% annualized yield on this. I like it better than investing in a GIC where I have to leave it in for the whole year or 2 years or whatever I buy. This I can take out at any time. Throughout the month, it goes up in value as it's anticipating the cash dividend for the interest to get paid at the end of the month. And then at the end of the month, it goes back down to $50 a share. So you can kind of see that in action here over the last year. I'm getting about 20 odd cents, sometimes 22, 23 cents a share per month. So that's about $2.50 a year. And that is my 5% dividend on a $50 share price. So I'm just holding a bunch of cash in cash in order to just safeguard it, get a 5% dividend yield. And then when there's opportunities in the market, I may source from this position a bit in order to invest in those opportunities. Next is probably my favorite stock. I own it in every single one of my investment accounts. It is CN Rail. This company has a great moat. They own railways that go from the east to the west of Canada, also south through the United States. No one's building new railroad tracks nowadays. It's just too hard to do. So great moat. It's so much of the presence that they cover with their tracks that these farmers and other people moving goods on these tracks to get to end consumers in those areas have no other way of moving their products other than CN Rail. So it really is almost like a monopoly. Hate to say it, but it's great for the business owners. You can see here in the last 5 years, up 35%, so about 7% a year. It's on a bit of a dip the last few weeks, and I get a starting dividend yield of 2%. They've increased the dividend yield every single year since they went public in the 90s, sometimes double digits, 10%, 15%, 20% raises. So it really does compound quick for you if you are a dividend growth investor, which is the role that this stock plays for me in this account. Looking at my position here, up about 4%, used to be up a bit more, but it seems like it's dipped down a bit the last couple of weeks. Have about $13,000 in CN Rail here. Going into Canadian Utilities. So Canadian Utilities is actually one of the only dividend king stocks, true dividend king stocks in Canada. Some people call dividend kings companies that have raised their dividend 10 years in a row, 20 years in a row. But the old meaning of a dividend king is 50 years in a row. And Canadian Utilities has increased their dividend 51 or 52 straight years, I believe. At this time, they're having actually a bit of trouble in the company. You can get a sense from the stock price. It hasn't really moved over the past 5 years. So they've really only been increasing their dividend about a cent a quarter or something like that, just like 1% increases as they figure their stuff out. Like lots of utility companies, Canadian Utilities have had some challenges just with the volatility of commodity prices. And all of these companies tend to hold a lot of debt. And in times where interest rates are going up, it's costing more to service that debt, lower operating profitability based off of that. And they're just kind of managing through that. But overall, still hopefully a great asset long term, one that just serves as a reliable flow of cash flow for me. Currently yielding up to 5.6%. This is actually probably as low as the stock has gotten since I first purchased it, for the most part, back in the mid 30s, I believe. Yeah, down about 10% here. Not too big of a position, about $4,000, but I do like my quarterly dividend that I do get from Canadian Utilities here. Okay, on to Diversified Royalty Corp. So this is one of my favorite royalty stocks because lots of the royalty stocks I own are just based off of restaurants, but this one here is actually a bunch of different businesses. They primarily get royalty revenue from Mr. Lube, so oil changes, window changes, tire changes, stuff like that at all Mr. Lube locations. A percentage of the revenue gets sent directly to the royalty fund. Even at times that people can't afford new cars and stuff like that, it just means they're going to be driving more of their old cars around, and more issues like that are going to happen. So I actually think partially, part of that business is very defensive because of that, right? Because lots of the older cars, they don't really go into the same place that they bought those cars 20 years ago, 15 years ago. They tend to have more of these little issues that they need to get fixed instead of buying a new car. And that's a tailwind, in my opinion, for Diversified Royalty Corp. Sorry, I keep choking on my words. Some other businesses that they own the royalty rights to: Oxford Learning Centers, you may be familiar with that business. Sudden Realty Group. So every real estate agent that works for Sudden's pretty hands-off. It's not like a Remax or something like that. They just pay Sudden $70 a month, and they kind of put their transactions through on the real estate agents' behalf, and that $70 a month times all of those real estate agents comes into Diversified Royalty Corp every month, and then gets paid out to you, the shareholder. They have two or three other businesses, like they have a trademark royalty agreement with a steakhouse that operates in some areas of the US and Canada. And they have a couple other ones, but I mentioned the big ones off the bat. You see here, I'm about flat on this one, down 3%, $6,000 position. The dividend yield on this one's about 8.5%. They just increased it recently. On these royalty funds, you'll see the dividends typically stay the same, but over at least like not month to month changing. But we do see a lot of 2-3% increases, 2-3% decreases in bad times, and that's really just because they have a mandate to provide all of the cash flow derived from the royalty to the shareholder. So they don't keep money in the company to invest in other things. No, these companies are meant to pay you a monthly paycheck. And if they want to invest in another business, buy another royalty stream, they just issue new shares to make that transaction happen, and hopefully in an accretive manner. But generally, you're getting every single cent, good or bad, whether it's above or below the dividend yield you think you're getting when you buy these funds. It's not really a balance sheet on these companies, so you don't have to deal with debt on the good end, but on the other end, it's not too big of a pool protecting you from a down year. Into the next stock here, Fortis. So everything I said about Canadian utilities also applies to Fortis, except Fortis, I believe, has more regulated utilities. They operate in the Caribbean as well as some areas of the US and Canada as well. The company's pretty large. If we look at their market cap here, $27 billion market cap, paying over a 4% dividend. The great thing about Fortis is they actually have been increasing their dividend about 6% every year since I started buying the stock in my TFSA like 7 or 8 years ago. So they really have turned into a reliable dividend grower, and they do have a pretty decent starting yield of 4% for a company that's increasing at that pace. So this is one that is just stable income for me that I like to have. You see here, past 5 years up about 30% before they actually pay that dividend. So the stock's done pretty well as of late, over the medium term at least. And now we get into some of my covered call ETFs. So HDIF. HDIF is a combination of lots of harvest covered call ETFs together. I think they also slap like 25% leverage on to really juice up the yield. You see here, down 7% in the last year. I'm down about 6% on the position, getting about 11% a year in dividends. So this is one of those stocks, and we're about to go through a handful of them, but one of those stocks that I just use for monthly income, and I use that monthly income to invest in other strategic priorities. I'm not currently focused on building my covered call income to be greater and greater month over month, just because I think there's opportunities that I can get dividend growth stocks at good values right now, and some other stocks at good values that I get all the upside on the equity. And I'm still pretty young, that while it's great having the monthly income, you are sacrificing some of the long-term dividend growth, some of the long-term capital appreciation potential. So I like having these as long as it's just a certain percentage of the portfolio, with the primary objective of just providing cash flow to fund other initiatives that I have in my account. Another covered call ETF I have here, going back 1 year, this one's down 10%. I'm down 6% on it, and it pays an 8.5% yield. So not levered up, so it's not as big of a yield, but it is Harvest Equal Weight Global Utilities Income ETF. So this ETF owns companies, think like pipeline companies, telecom companies like AT&T, Verizon, Enbridge, companies like that all over the world. They put them in a fund. You get the dividend yield. On top of that, they sell the premium. So if the stocks go up a ton, someone can call an option and buy it away from the company at a certain price. Then they just buy it back, but they do lose some of the equity because of the stock price going up past that point. So they have to buy back at a higher amount. And that's why you get a lot of top line share appreciation pressure on these names. They don't typically go up. Usually if they are relatively flat, you did pretty well because the dividends are all 7 to 10% for the most part, and that's the total return you can really hope for. Okay, going into the next stock here, it is Jamieson Wellness. This is a stock I'm currently building out of my portfolio. I only have 60 shares, so I'm growing it pretty quickly. Just had 20 shares a few weeks ago. In the last year, this one's down 27%. For those of you who don't know, Jamieson Wellness is a health brand. They sell lots of minerals, vitamins. I think they're the largest vitamins and mineral seller in Canada. with their namesake brand Jamieson. They also acquired a brand called U Theory in California, and it also operates in the U.S. They're going to try to use those relationships, those salespeople, to maybe bring Jamieson into the U.S., which would be an interesting experiment, see if that sticks there in a much bigger market. They also bought out their Chinese distributor and wholesaler, so they're operating a completely owned business in China right now, and they also distribute out to Europe as well. So they're getting to be increasingly global, doing a lot for a company with a $1.1 billion market cap. But they do generate about $80 to $90 million a year in cash flow. So I feel like they're trading at a reasonable valuation here, trading at a 2.7% dividend yield. Like I've discussed in some other videos, I really do like Jamieson because of the industry they play in. I think it's a growth category. On top of that, it's really hard to get these consumer products companies on the Canadian market, which have a lot of benefits. I don't have to pay for FX fees. I don't have to pay additional taxes on the dividend income. I don't have like currency risk. So it's so many different variables that just make this stock one that I'm interested in, aside from the fact that I just think the valuation is good here. Expected to do about $1.60 a share. So they're trading at around a 16 times valuation for this year on the company. And you look at their 52-week high, closer to $40. They're trading pretty close to the 52-week low here. So it's one that I've kind of just been nibbling on here and there. You know, if it blows up to $35 or whatever, will I sell it? Like maybe if I don't get the opportunity to build a real position. But until then, I am holding on to that one. Next stock here, Keg Royalty, similar sound bites as A&W Royalty, except for the caveat that this is less defensive because it's a sit-down restaurant, relatively high-end, expensive checks. Check size at this business here. Looking at the company past 1 year, we're down 12% on Keg Royalty. Over the last 5 years, you can see the chart here is at around $17.50, dipped huge during the pandemic, was recovering, was at $15, $16. Looks like it's trending down here. They had one earnings report that wasn't great. They had volume loss behind lots of pricing they took. And then now I think there's also just some general economy concerns. But at these levels, you're getting over an 8% starting dividend yield. So you're getting that monthly yield and monthly cash flow to wait and hope the CAG goes back up. And even if it doesn't go up too much here, you're still getting that 8% a year in dividends. Next is another covered call ETF. This one's in the healthcare space. So think companies like Pfizer, Moderna, AbbVie, companies like that are all owned in this ETF. This one's actually done pretty good, up 3% in the last year on a covered call ETF. So 3% gain in the last year. I obviously didn't time it well. I'm down 3%, but you also get a 9% dividend yield. So I'm probably up around 6%, give or take, on this guy. If you've held it for the full year, you're up closer to 12% on this one. So one of the success stories, it looks like, over the short term, at least on these covered call ETFs. Next is my worst performing stock, Northwest Healthcare. Northwest Healthcare has had a lot of issues. I believe they had a joint venture go awry in the UK. They have a lot of management fees from managing hospitals and stuff that has performance elements that have just gone to the floor with interest rates going up and the operational issues that has caused in lots of their businesses. But I really do love lots of their underlying assets. They own lots of hospitals in Brazil and Australia with long 30, 40-year leases that have government tenants. So really stable cash flows there. I don't know what's going to happen with the dividend here. Currently, the dividends got all the way up to almost 12% on the stock, but we'll see if they end up cutting it, if they start using that cash flow to pay back debt or to manage the business a bit differently. They did approve it for this month in September, but no word yet on what's going to happen in October and ongoing. Okay, going to Restaurant Brands International. This company here owns Burger King, Popeyes, Firehouse Subs, and Tim Hortons, which is mostly in Canada. But lots of their other brands, like Burger King, is really an international company. Popeyes, they're increasingly trying to expand internationally. So big international presence and international aspirations for this one. Looking at it in the last couple months, we were over $100 in July. So we're down about 10% from there. Overall, in the last year, though, we've still had a lot of success, up over 16% in this one. Looking at my portfolio, I'm up 22%. I bought in at a pretty good time, and I'm also getting between 3 and 4% dividend yield on top of that gain. So great business. They really focus on the franchise revenue. They don't really want high capital costs, so they just franchise new restaurants for the most part now. They don't open too many of their own. They take the licensing revenue to open up the franchise. On top of that, they also take a percentage of sales, so they're getting ongoing income streams. Every Tim Hortons, Burger King, Popeyes, Firehouse Subs that's open, that's not corporate, is just essentially a royalty company in its own right. They're managing the menu innovations, they're managing the marketing, but they're just getting a percentage of top line revenue, really high margin revenue that's coming back into these corporations here. Okay, next is Rogers. So Rogers Communication, they just finished a huge acquisition or merger, however you want to look at it, of Shaw Communications out west. So I do own about $5,000 of stock, down a couple percent here. I get about a 3.5% dividend yield. I've been holding off on buying more until I better understand what the total business is going to look like after they fully integrate Shaw, they fully get the synergies. I'm going to wait and see how it plays out before investing more in Rogers. So going to wait at least another quarter, maybe another two, see how it goes, and then I may consider it back on my list if I think the valuations make sense. But I'm kind of on the sidelines on this one for now, even though I do really think I do really love some of their exposure. They're the #1 wireless company in Canada, so lots of Canadian cell phone plans, about 10 million of them go through Rogers. That's really strong recurring income stream and super profitable for the company. Obviously, cable is something in the US that's declining at a super fast pace, not as fast in Canada. So that's just a watch out if that accelerates in Canada, maybe some pressure on these telecom companies. But so far, it seems like we're well behind the US. So maybe not a short term issue, even though it's probably still a longer term issue on this company. And then TD. TD is the second bank that I own in this account. We went through Scotiabank earlier. You see TD here down 6% in the last year. You see they had some issues here with that huge banking crisis that happened in the US. The stock dropped like 15%. At that time, they were still in contract to acquire that company First Horizon in the US. That deal eventually fell through, which seems like it was a benefit to the stock. Bouncing back from there. Ultimately, they're expected to do about $8.30 in EPS next year, so trading right at 10 times earnings. Huge presence in the US on this bank. I've made lots of videos that include TD, so I don't want to go too far into it, but paying a 4.5% starting yield here, not too bad for the quality of bank that they are, in my opinion. Then wrapping up my Canadian stock portfolio with 3 Canadian ETFs. First one, XIC. This is just a TSX market ETF. Look at it over the past 5 years, up about 5% a year. I'm getting a 3% dividend yield on it. It's a super new position, as you can see here. Just have $600 in it. But looking to build this up and up. Just bought some of this stock in some of my other accounts. My rationale for owning this stock is, in the Canadian economy, I really just invest in things I understand more. The banks, the REITs, the royalty funds. CN Rail is a company I've owned for a long time. The regulated utility companies. So it's a lot of outages, whether that's energy, whether that's retail, whatever it may be. And I just want to own the basket so I'm not kind of blinded by what I don't know and I have exposure to the entire economy. So I'm expecting this to build into a much bigger position. One thing I really like about XIC is the management fee is only about 5 basis points. So I'm paying pretty much nothing for the right to own all these stocks in one name. So I really do like that element of it. On the covered call ETFs as a watch out for those of you who are going to look at some of those. The management fees tend to be very high because they're actively managed. They are going in every month writing covered calls. So you typically have to pay between 50 and 75 basis points for lots of those. So it really does take a true chunk off the top to get that monthly income. ZDI is BMO International Dividend ETF. So this is a company that owns tons of blue chip dividend paying stocks in Europe and Japan and Australia. So it just gives me really great diversification geographically. See here up about 12% or $1,000. Also get about a 4% dividend yield, which is great. on this company here. So that's one that I do like for diversification. The one prior, XIC, was all Canada. This is all outside of Canada, which is great just to make sure not all my money is being invested in one economy. And then lastly, on the Canadian side, it is exposure that is not Canadian, which is ironic, but it is the ZQQ. This is a NASDAQ 100 ETF hedged for currency. So I get exposure to the largest 100 tech companies. I own some of them personally, individually rather, but this is just all those companies in the NASDAQ 100, whatever it may be: Tesla, Apple, Nvidia, Google, Amazon, Microsoft, goes on and on, Meta. So just get some tech exposure here. You can see up 25% in the last year. So this one is a position that is not too big for me, just $2,000 or $3,000, I think. Yeah, $2,700 as of now. Just bought into it in this account a few weeks ago, so just up about 4%. Okay, so that's my Canadian portfolio. If I was going to sum up my Canadian portfolio, lots of the weakness in the last year, 18 months, has really been around the interest rate sensitive stocks, the REITs, the utility companies. Those kinds of companies have really been dragging down my portfolio. We went through Allied already. Northwest is a disaster. Canadian Utilities was one that is near the lows that it's been at since I bought it. As I continue to scan through, covered call ETFs have been a bit of a wash. Probably gained 1 or 2, maybe 3% on them when I incorporate the dividend, but definitely haven't been tremendous returns. And then just some weakness in the banks as well, around some uncertainties in the economy there. Okay, so going over to the US stock, and just since I'm in the middle of the video, just a reminder, if you haven't yet, be sure to give this video a big thumbs up. It means a lot to me to go through this and to share my whole portfolio here with you. So if you appreciate it, be sure to give the video a thumbs up. Thanks so much. In the last year, stock portfolio is up 20% on the US side, about 10,000 US dollars, which is really great. Going through these ones, Google has just exploded up over 20% here. I've actually started buying a bit more Google in the 130s, so it was up even more than that on a percentile basis, but still a really strong return here. Seems like they just completely flipped the narrative on AI. Lots of investors thought that Microsoft was going to take them over on search and all this other stuff, but it seems like they've actually turned that script around. They're using AI to their advantage, and the kind of rhetoric around AI is boosting the stock. They've also turned their Google Cloud offering from gross margin negative to gross margin positive for the first time since they launched that product, which investors were cheering as well. That was awesome, and that's really been driving the stock up. Coca-Cola has been one I've been buying aggressively this year, up to 180 shares, about $10,500. My average price is $60, so it's a bit below that here, but I'm really in this one for the long run. I'll gladly continue to average down if it goes much farther. Getting a 3.1% starting yield, but they're a true dividend king, increased their dividend more than 50 years in a row. So that dividend yield will go up for me every single year between now, likely until after I die. PE of 24 times, which is great. Looking at the company over the last 5 years, up 26%. So it's performed pretty well, even though they're in a bit of a down run here. If anything, I'm happy to be able to average in on a bit of a drop as I build this into a bigger position. McDonald's. So McDonald's, I don't have a huge position in this account, just 7 shares, up 20% there. The current dividend on McDonald's is just over 2%, but similar to Coca-Cola, they increase the dividend every year. They are the largest restaurant chain in the world, super efficient business, get tons of royalty and rent income because of all the real estate they own from their tenants. So this is just a great business, really expensively priced though. You see the price to earnings, 25, 26 times for a restaurant company essentially, and a fast food company at that. So a bit rich, but a great business. So I honestly understand it. And that's why I'm not selling, or I don't think they're grossly overvalued, because this is a company that continues to buy back their shares, increase their dividend, increase same-store sales growth, open up more locations globally. They're really firing on all cylinders, so they deserve that type of valuation. Next is Meta. This is the stock I'm up the most in this portfolio, up almost 200% there. Not a huge position, just a huge gain on it. a wild chart on this one, up over 100% on the last year. If you go past 5 years, you can see the roller coaster long-term investors have been on with Meta. Personally, I'm a huge advocate of them slowing down their investments in Reality Labs. I think that's a ton of cash flow with like no immediate return or no return in sight. So I'd really rather them not make all those investments, but we'll see how it goes. And hopefully that CapEx slows down on that side, and we start seeing higher revenue and some kind of line of sight to a return on investment over the next 5-10 years. I'd rather that be funding share buybacks, funding other types of investments that have return on investment in sight. But ultimately, that crash in the stock because of that enabled me to buy 11 more shares in this account and get this $2,200 gain. So I can't be all mad about it. Going into the next stock, it is Microsoft. Microsoft is a beast of a stock here, up over $2,200, about 33% here. And they've just been firing on all cylinders. For those of you who don't know, Microsoft owns Xbox. It looks like they're about to close on an Activision Blizzard takeover of about $70 billion, which for Microsoft is just like 1 year of net income for the company. So they're just going to swallow it right up. They still have a ton of cash on their balance sheet. They also own businesses like LinkedIn, Office 365, Azure, which is cloud competitor to AWS at Amazon. So tons of great high growth businesses for them. They're trading at about a 30 times forward earnings. Pays a little dividend yield. They increase it every year, but it's nominal. It's not too big in the grand scheme of things there. And we are going down the home stretch here. Realty Income Group is a stock that I just started buying a few months ago, and oh boy, has it been bad timing. So I've started buying in the low 60s here. Went up initially to 64, and then straight down about 15%, give or take. Overall, I'm down 10%, average down a tiny bit on this one, currently at $54. I have a dividend yield of 5.6%. I really do like the stock. I like how they have presence in all 52 states. They have 10% of the business in the UK. They also have a lot of presence or building presence in other areas of Europe, like Spain, like Italy, which is great global diversification for me from a real estate perspective. And they also are kind of building their portfolio of more flagship assets as they kind of get tapped out a bit on real estate or retail, excuse me. So they just bought 20% of the Bellagio in Las Vegas for about $1 billion, which is a huge deal for them. And really like to see them build up that scale. They can synergize operations. They can synergize technology. They get the opportunity to be a part of bigger bidding wars for bigger classes of assets. So I'm a believer long-term in real estate, and I think Realty Income should do well. Obviously, interest rates are hampering the valuation of these assets, but in the meantime, as interest rates kind of stay where they are, I'll take the 5.6% starting yield. And they increase their dividend like crazy. Even though these increases are just 0.5% here and there, they increase them multiple times throughout the year. They've paid their dividend for like 600, 700 straight months. So just a great business to own here for the long term, in my opinion, even though, it's hard to time all of these things perfectly. P&G, similar company here as Coca-Cola, as McDonald's, great business in my opinion, great diversification around the world. They have a lot of different product categories like Pampers, like Gillette, like Mr. Clean. They're all over the place. They pay a starting yield of 2.4%. And like Coca-Cola, they are a dividend king. So they increase this dividend every single year. PE in the mid-20s as well, which is pretty standard for these types of companies. But you're really paying a premium to sleep well at night owning these companies, knowing that nothing's going to crash or unlikely for anything material to happen overnight. I'm just going to race through some of these for the sake of time. S&P Global here. This is a pretty new position I bought, up 13% in the last year. They trade at a forward P of about 28, 29. P here looks elevated. Not sure if there was some tax thing in the base. Yield of under 1%, but they increase the dividend every year. They have three or four main divisions. One of them is on credit ratings, which is a duopoly between S&P Global and Moody's. Love that business, very defensive. No matter what's going on in the economy, people are going to be trying to raise money, raise debt, do something, and all of those securities need to be rated by either S&P or Moody's to get any kind of traction in terms of sales with investors and with professional organizations. In addition to that, they own the S&P index. They also own the Dow Jones index. So anyone who's buying these indices through ETFs, probably about a basis point or so is going to S&P Global every single month. So that's super recurring passive income for them. As more and more people move to investing their money and move to index investing, they'll benefit from that. They also have a market intelligence business, which I've been learning more about. It's super recurring in nature as well. And I love the exposure of that business. And then they have like an energy energy data and intelligence business, which I'm a bit less familiar with, smaller part of the business, but also looks to be like an important data business as well. So they operate in big data. They provide services. There's really big moats like credit ratings, like indices for global standards of investing, like S&P 500. So I do really like the business. It does trade at a rich valuation, but I think it's deserved that multiple. And this is just going to be one of those companies that I invest in and hope for the dividend growth year over year over year, and for these yield on cost to eventually turn into something noteworthy 10, 20 years down the line. As you can see, I have lots of high starting yield stocks, so it's nice to have some of these growth stocks as well. Talking about high starting yield stocks, AT&T trading at $15 a share here, down 25%. This one's been one that's hurt me as well. 7.4% starting yield. They're expected to do about $2.50 a share of free cash flow. So we're trading about 6 times free cash flow as long as they hit their number. I get that these companies aren't necessarily growth companies, but I do think, in my opinion, similar to Allied Properties, that at some point they've gotten devalued too much. And I think that 6 times free cash flow, if they actually hit that number, is a great value for a company like this, with some of the businesses that they have still being very strong with wireless and whatnot. So I do like this stock, and I'm hopeful that the net present value of AT&T is significantly higher than $15, and I guess we'll see in the years to come on that one. 2 stocks left. Visa. On Visa, clicked AT&T again. But on Visa, very similar narrative to S&P. Kind of the role it plays is as a dividend growth stock, very small starting yield, but increases very much over time. Currently trading at a PE, I believe in the high 20s for forward PE, 27, 28 times. $244 here. Looking at how well they've been able to grow, 65% over the last 5 years, despite what we've gone through in the economy. For a payment company is tremendous. They essentially have a royalty, as I really like royalty companies, as you've seen from the rest of my portfolio. They essentially have a royalty on the global economy. Anytime anyone uses a Visa card, they're getting a couple cents from that transaction. Extremely high margins. They have like 80% gross margins, 50% net margins, and it's all just coming to investors because they really have very limited capex, because their network's reliable, not really needing a ton of investment. Their capex is about 3, 4, 5% of their total income, and then they just return tons of value to shareholders through share buybacks, and then increase the dividend 10, 20% every year, it seems like. So this is a great growth company. Their biggest risk is regulation, right? They have a lot of tailwinds in terms of just the general economy growing. Inside that economy growing, people doing more card payments versus cash payments. Cash is dying around the world in lots of developing countries still. And then on the other side of the coin, it's just, is there more red tape that comes up because these businesses are just so profitable, touching every single business, getting pretty much a partner of every single business in the world, taking a couple percent of their top line to provide the services of quick payments and secure payments. So we'll see what happens with regulation, but I think this is just a great business and should hopefully continue to strive and do very well with a great product, a huge lead with Visa and MasterCard above everyone else. You got Amex there to some degree, but a great business here, and one that I wish I could have bought more at lower valuations, currently up 15% in this portfolio here. And the last stock, this is a pretty new one. It is an ETF, VXUS, the Vanguard Total International Stock ETF. This company here essentially owns market ETFs for every single country, for the most part, that has publicly traded markets, except for the United States. So my rationale for owning this stock is, I have a ton of exposure to the US. Lots of my US companies operate primarily in the US. Even lots of my Canadian companies operate in the US. You think like CN Rail and those businesses have a lot of business coming in and out of the US. So I wanted a stock that got me global diversification, truly global diversification. I'm talking China, I'm talking Australia, I'm talking Europe, I'm talking Africa, I'm talking Latin America. I want everything, even India's in this ETF, without being diluted with the US because I already have such big equity investments in the US organically through Coca-Cola, through Realty income, and all these other means. So this is just to cover off the rest of the world so I don't necessarily have to worry about it. Another one, just like XIC, helps me sleep well at night knowing that I own a presence in all of these different countries, all these different equities. On top of that, I get paid a 3% plus dividend on this one. And they have tons of liquidity, market cap of over $57 billion. So probably one of the biggest ETFs in the world that people are buying to get exposure to international markets. So love having that one for diversification. And the dividend's just a bonus on that one as well. So that is my US account. As I said, up over 20% here in the last year. Some of the drivers, obviously Meta, up 200%. You got Microsoft up 33%, Google up 20%. Surprise, surprise, big tech really doing most of the driving. P&G is helping out a bit too, holding up pretty well there. And then Visa can throw that in the big tech bundle. So essentially all of big tech's driving my portfolio up, where real estate is dragging it down, as well as telecom, so AT&T. So dividend stocks with high debt dragging my business or dragging my portfolio down, whereas technology is holding it up. Similar story is what's happening on the Canadian side. It's just less technology on that side because we don't have as much of that on our stock market. So at least I'm getting the benefit here on the US side. I wanted to thank you guys. If you guys made it to the end of the video, that's amazing. This is a really long one. I don't even know how long this one's going to be, but it's going to be long. Really thank you guys for making it to the end. Truly appreciate it. If you haven't yet, be sure to let me know that you made it to the end in the comment section. Would love to chat with you guys, and be sure to give this video a big thumbs up. Thank you guys for watching. Be sure to subscribe to the channel, and I'll see you guys in the next one. Thanks.